So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to the Daily Call from Option Alpha. Hey everyone, Kirk here again at Option Alpha, and welcome back to the Daily Call. Today we're going to be talking about laddering option trades and specifically frequency and pricing guidelines that you might be able to use. So first, let's talk about what are laddered option trades. Well, it's a concept that we often refer to, and basically what it means is that we're not going to enter one big stinky position around a strike price and plant our flag in the sand and say, this is our position for the next month. Instead, what we'll do is if we're going to enter, say, 10 contracts, we'll try to split that up into a couple different entries, maybe 3 different sets of trades, 3, 3, 4, something like that, where we start averaging around the security, start averaging down or up as the security starts moving. So for example, if a stock is trading at $100 and we want to do some straddles, we might sell 3 straddles at 100, then wait for the stock to move. If it does move up to say 103, we'll sell another 3 straddles at 103. If it moves up to 106, we'll sell another 3 straddles at 106 and start moving up with the position. We found that this works really, really well in backtesting and research-wise because we spread our entry out over time. We increase our trade frequency, increase our duration in trades, and also spread out our strike prices, which means that we have overall wider break-even points on the overall position. So it really actually works out well. So as far as frequency goes, I do not have a set frequency that I stick to. So I don't say every week I will get into a new position or every 3 days I will get into a new position. For me, it comes down to movement. If the underlying security is not moving, I will not add another laddered position. So to get back to our example, if we have a stock that's trading at $100 and we sell the first set of 3 straddles at $100, if the stock just stays at $100, maybe goes up to 101, goes back down to 99, then back down to or back up to 100, I'm not going to add to that. The stock's doing exactly what I thought was going to happen. Now, we don't have a big position on, so we can't capitalize on it as much as we hope. But in this case, the stock's doing what we want, so we're not going to add a position to it. But let's say 2 days later, the stock jumps up to 103 or 104. Okay, then I'll add another laddered position. And maybe 1 day later, the stock jumps to 106. And now it's had a huge move in just a couple days. Okay, maybe then I add another laddered position. So for me, it's about strike price spreading. So like I want to spread out my strike prices across different movements in the stock. So if that happens very quick in a couple days, great. If it happens a little bit later on in the cycle, and I have to wait a week or 2 before I get into another laddered entry, I'm fine with that too. I'm not like beholden to any one particular timeline or frequency for getting into laddered trades. As far as pricing goes, I base pricing and kind of the number of contracts that I do generally off of implied volatility. So if we see low volatility, I'll do a couple contracts, maybe 2 or 3 to start and keep doing 2 or 3 unless implied volatility goes higher. If we start to see implied volatility go higher, then we'll start to see more premium in those contracts and we'll start to scale up. So if we start with 3 contracts, but the next move, we also saw implied volatility jump, then that means that we might do 4 or 5 contracts the next time around. So I think starting small is always the better opportunity. We know that we're never going to be perfect in picking direction. We know we want to trade consistently neutral. So why not use an option technique like laddering to help facilitate that kind of concept of non-directional trading, not needing to pick the market? Just trade where the market goes. If the market goes higher, continue to add new trades at higher strikes. If the market goes lower, continue to add new trades at lower strikes. And then scale based on volatility. So if it's low volatility, scale back your position sizing. If it's high volatility, scale up your position sizing. As always, hopefully this helps out. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to play smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.